Welcome to HYCM Insight with myself, Giles Coughlin, Chief Currency Analyst. Now, the market move for the session ahead as follows. The latest retail sales out of New Zealand surprised to the upside, coming at 2.5% versus minus 1.6% previously. Now, by industry, the main movements were electronic goods up 8.4%, recreational goods up 16%, hardware, building, garden supplies just under 5%, and department stores up over 5% at 5.6%. So there's decent demand in the retail sector for the New Zealand dollar. There is an outside chance that perhaps the RBNZ will be a little bit more optimistic at the rate meeting coming up. Now, the Australian dollar, by contrast, is currently pressured by falling iron ore prices. And if these prices keep falling, then the Australian dollar should face further weakness. Remember, the Australian economy exports around 20% of its exports are iron ore, 80% which goes to China. So falling iron ore prices should drag on the Australian dollar. Also notice the RBA is trying to target very low unemployment levels. They're looking unlikely to reach these levels of around 4% until 2024. So you can see the bond yield spread here, the yellow line. Do you see how that is tracking lower? Now, the bond yield spread tends to show a risk profile between the two nations, and the bond yield spread dropping lower. Typically, you would expect the Australian New Zealand dollar to follow the bond yield spread lower. So there is a risk that there'll be near-term selling ahead of and out of the RBNZ rate meeting. Key trade risks: if iron ore prices do move higher again, that will invalidate this outlook. Also, if the RBNZ are more dovish than the RBA are, then this will also invalidate this outlook. The bond yield spread should flag any major changes at the RBNZ rate meeting.